It finally happened. The red line has been crossed. For a decade, it was just sanctions. It was diplomatic pressure. It was covert operations in the shadows. But today, the United States government stopped asking nicely. Nicolás Maduro, the president of Venezuela, is in U.S. custody. But while the mainstream media is obsessing over the politics, the international law, the diplomatic fallout, they are missing the real story. The story that is flashing red and green right now on the trading terminals of Wall Street, London, and Shanghai. Look at the silver chart. In a market that was supposed to be asleep, silver just ripped upward by nearly 3.5% in a single session. That is not a normal trading day. That is a violent, vertical wake-up call. Gold is chasing it, breaking $4,400, but silver is outperforming everything. Why? Why does the arrest of a South American leader trigger a massive panic buy in a conductive metal? Because the market knows what the politicians won't admit. This isn't just an arrest. This is a declaration of economic warfare. The safe haven trade is back with a vengeance. The illusion of stability is gone. And when the world's most powerful military decapitates a sovereign government, the smart money doesn't buy dollars. It buys the only thing that has no counterparty risk. Welcome to the new volatility. Welcome to the silver shock. To understand why silver is exploding, we first have to understand the magnitude of the chaos we just stepped into. This wasn't a random event. The detention of Nicolás Maduro creates an immediate, catastrophic power vacuum in one of the most resource-rich nations on Earth. Venezuela isn't just a failed state. It is a mineral vault disguised as a country. For years, Venezuela has been a client state of the East. China has poured billions into infrastructure there. Russia has sent military advisors. They have been using Venezuela as a forward operating base. By arresting Maduro, the United States has effectively severed the head of that operation. The markets hate bad news, but they fear uncertainty. Is this a coup? Is it a restoration of democracy? Or is it the start of a civil war that will lock down the Caribbean shipping lanes? Investors looked at this chaos and realized that the global order is dead. If the rules are dead, then fiat currency, which is built on trust in those rules, becomes vulnerable. That is why the algorithms triggered the buy orders. At 9 a.m., the news broke. By 9:05 a.m., the flight to safety began. And leading that flight wasn't the U.S. Treasury bond. It was silver. So what happens tomorrow? Do not expect this to blow over. Do not expect the price of silver to stabilize. The arrest of Maduro was the stone thrown into the pond. The ripples are just hitting the shore now. The market has moved from a state of efficiency to a state of emotional distress. We are entering an era of extreme price swings. A 3.5% move in a single day might become the new normal. We could see 5%, 7%, even 10% intraday swings as the geopolitical situation deteriorates. If you are an investor, you need to understand that the spot price you see on your screen is struggling to keep up with reality. The paper market is trying to suppress the price, but the physical demand, driven by fear, is pushing it up. The question isn't, did you buy? The question is, do you have the stomach for what comes next? The game has changed. The era of cheap, stable silver is over. The era of scarcity and volatility has begun. And don't blink, because the price action we saw today is just the beginning. Let's dig into the numbers, because what silver is doing right now is historical. Usually, silver moves on industrial news, manufacturing data, solar panel demand, tech output, but today, silver is behaving purely as monetary metal. This 3.5% spike is what we call a fear premium. When geopolitical tension hits the red zone, large institutions deleverage. They sell risky tech stocks and they park capital in hard assets. But why silver specifically? Why is it moving so much more violently than gold? Because silver is the high beta version of gold. It is gold on steroids. When the fear is real, silver moves faster, harder, and with much more volatility. The arrest of Maduro signals to the world that the US dollar is being weaponized to its absolute limit. If you are a foreign nation or a foreign central bank, holding dollars suddenly feels like holding a liability, so you diversify. You buy metal. This 3.5% jump is the sound of capital fleeing the traditional banking system. The supply chain panic. Now look at the industrial side. This is where the volatility gets dangerous for the tech giants. We are already in a structural silver deficit. The world consumes more than it mines. Now throw in a massive geopolitical shock. If Venezuela falls into civil unrest, if shipping lanes in the region are contested, the cost of moving commodities skyrockets. This creates industrial panic. Companies like Apple, Tesla, and Samsung operate on just-in-time inventory. They don't have vaults of silver. When they see silver spike 3.5% on a headline like this, their procurement departments start to panic buy. They need to lock in prices now before silver hits $50 or $60. This creates a self-fulfilling prophecy. The panic creates demand. The demand drives the price up. The rising price drives more panic. We are watching the beginning of a commercial short squeeze driven by geopolitical fear. The China factor. And don't forget the silent war between the US and China. China has been hoarding gold for 18 months. Now, watch them accelerate their purchase of silver. If China believes the US is cutting off their resource colonies in South America, they will vacuum up every available ounce of physical silver on the London and Shanghai exchanges to protect their manufacturing base. They are preparing for a blockade. The Maduro arrest was the signal that the blockade has effectively begun. This massive buying pressure from the East is colliding with panic buying from the West. That is a recipe for explosive volatility.
Reuters has just released its latest macroeconomic report titled "Gold Prices Slip Lower as U.S. Inflation Figures Firmer, Dollar Rises." On the surface, the market appears to be reacting strictly according to the textbook. When the U.S. dollar index, DXY, strengthens, algorithmic trading models automatically trigger sell orders for precious metals. The investing crowd is currently focusing their attention on gold, assuming the upward trend has stalled due to the hawkish macro environment. However, if we look deeper into capital flow data and the underlying market structure, a massive anomaly is currently unfolding in silver, one that retail investors are largely missing. While short-term price charts indicate selling pressure driven by high-frequency trading algorithms, the actions of smart money in institutional accumulators are telling a completely different story. This is not a sell-off to exit positions. Quantitative data suggests this is a classic liquidity shakeout. We are witnessing a sharp divergence between the paper price, futures contracts, and the physical price, real metal. While the paper price dips, physical premiums are rising. This mechanism is designed to flush out weak hands and leveraged speculators, allowing institutional players to acquire positions at a discount before the market establishes a new price floor based on actual, undeniable physical supply scarcity. Let's dive into a forensic analysis of the market data to understand the gravity of the situation. In October 2025, China made an unprecedented move, exporting 660 tons of silver in a single month. To put this in perspective, this volume exceeds their typical annual export quota and runs completely counter to the strict strategic resource controls Beijing implemented earlier this year to protect supply for its domestic solar manufacturing base. According to basic economic laws of supply and demand, when such a massive supply shock hits the global market, asset prices should drop sharply due to the sudden surplus. But what is the reality? Silver prices not only didn't crash, but they also continued to break historical highs, surpassing $66 per ounce this December. Why this paradox? The answer lies in the rapid depletion of the Shanghai Futures Exchange's stockpiles. Data shows that silver inventory in Shanghai has collapsed. From a peak of 3,911 tons in January 2021, only about 780 tons remain today. Effectively, they have burned through nearly 80% of their strategic reserves in less than 5 years. The export of those 660 tons was not a commercial sale of surplus inventory, it was an emergency liquidity injection for the London Bullion Association. The London market is currently facing severe backwardation, a condition where current prices are higher than future prices, signaling a physical squeeze. China was forced to act as the supplier of last resort to arbitrage the price difference and prevent a breakdown of the global pricing mechanism. So where did that massive amount of silver go? It didn't stay in London vaults. Import data reveals a massive shift of physical capital towards India. In just September and October alone, India imported a staggering 2,600 tons of silver. The metal flows are moving from Chinese reserves through London and Hong Kong intermediaries and are being completely absorbed by India. This is not just jewelry demand, it is a strategic accumulation by Indian industrial conglomerates preparing for their own green energy transition.
This leads us to the bigger picture regarding fundamentals, which are currently stronger than at any point in the last 50 years. The year 2025 marks a collision between two opposing forces, inelastic demand versus finite supply. On the demand side, we are seeing inelastic industrial demand. The global transition to net zero relies heavily on silver. Solar. The latest TOPCON and HJT solar cell technologies require 20 to 50% more silver per panel than previous generations. This is a classic example of Jevons paradox. As solar technology becomes more efficient and cheaper, total adoption skyrockets, driving aggregate silver consumption higher, not lower. AI and tech. As we build out massive AI data centers, the need for high-performance connectors and switches is exploding. Silver has the highest electrical conductivity of any element. It has no substitute in these high-efficiency applications. Manufacturers are forced to buy silver, regardless of the price, whether it is $30 or $100, to keep multi-billion-dollar production lines running. Crucially, we must also consider the geopolitical risk premium. Silver is transitioning from a monetary asset to a strategic national security asset. Major producing nations like Mexico and Peru are increasingly discussing resource nationalism policies. If these governments decide to increase royalties or nationalize mines to capture more revenue, the global supply chain faces an immediate shock. We are moving away from a globalized free trade market for minerals to a fragmented protectionist environment. On the supply side, the situation is critical. We are facing a structural deficit. Mining output is flat or declining due to years of capex starvation and falling ore grades. Furthermore, 70% of silver is mined as a byproduct of zinc, lead, and copper. Even if silver prices double, copper mines will not ramp up production just to get a little more silver. This supply inelasticity means the market simply cannot respond quickly to the demand shock.
So, what is the scenario for the near future? At the current burn rate, the visible inventory in Shanghai is sufficient for only about 2 more weeks of trading. When this buffer disappears, the market enters uncharted territory. We anticipate a decoupling event. This occurs when the paper market, futures, derivatives, and the physical market break their correlation. Currently, the paper market operates on massive leverage known as rehypothecation. It is estimated that for every ounce of physical silver in the vaults, there are potentially hundreds of paper ounces traded. As long as investors are happy settling in cash, the game continues. But when industrial buyers, who need the metal for production, start demanding physical delivery that the COMEX or LBMA vaults cannot meet, the system breaks. Exchanges may declare force majeure and force cash settlements. This is the ultimate short squeeze. Short sellers will be forced to cover their positions at any price, pushing the price chart vertically to find a new equilibrium where demand is finally destroyed. a price likely much higher than today's levels. My strategic advice for investors is as follows. Do not let short-term volatility based on CPI prints or Fed speeches distract you from the geological reality. We are looking at a mathematical certainty of depletion at current prices. Institutional allocation to silver is currently less than 0.5% of global assets. If that allocation merely shifts to 1%, the buying pressure would be overwhelming. Silver is currently in the most attractive valuation zone relative to its growth potential. The gold-silver ratio is currently hovering near historical extremes. If this ratio reverts to its historical mean of roughly 60-1, or the geological ratio of 15-1, the upside potential for silver presents a highly asymmetrical risk-reward profile. This is a phase of wealth transfer. It is a transfer from those holding depreciating currency and unbacked paper contracts to those holding essential, finite, real assets. Ensure you are on the right side of this transfer.